Welcome from me, Guy Munson, to this month's 6-Minute Strategy. After what's been an almost uninterrupted bull run across global equity markets following President Trump's Liberation Day speech on April 2nd, markets have finally paused for breath. The recent correction has been modest and frankly it's probably a healthy one. It reflects not only the lofty valuations that many of the AI leaders now command, but also a few darkening macroeconomic clouds that are beginning to gather. We're seeing, for example, signs of softness in both US and UK labour markets. And even though the data is still foggy given the ongoing government shutdown, it is slowing. Core inflation too remains stubbornly high. Now, none of this yet points to a global recession, but the momentum we saw earlier in the year is clearly slowing. Against this backdrop though, Q3 corporate earnings have been surprisingly good, beating expectations again on both sales and profits. Meanwhile, US share buybacks remain strong and global dividends continue to rise. So despite tariffs, deficits and other macro data, the world's equity blue chips still appear in remarkably good health. We'll look at how long this can continue in the slides ahead. So let's begin by looking at Q3 earnings around the globe in terms of their beats versus analyst expectations for sales and earnings. This is a snapshot of my Bloomberg screen, so let me explain. That first line in light blue, all securities, that's the total number for the index, shows sales up by 2% against expectations and earnings up handy 5.9, nearly 6%. Now those are good numbers. If you look in the box on the left-hand side and the bottom, those blue bars, is those quarterly numbers for earnings going back in history. And you can see this number is probably one of the best in the last 6 quarters. So despite the growth to date, earnings and sales appear to be growing even faster than expectations going ahead. Now, critically, can this continue and can it justify higher equity market valuations? Well, to answer that question, I'm looking at 3 items. The first is the impact of Trump's tariff agenda. The White House position is broadly falling into place with an average tariff rate of about 17.5%. And that's high. It was 2.5% before Trump's second term. But it is having some benefits. It's collecting big numbers for the US Treasury, 34 billion or so a month, rising to totaling around about 400 billion for the full year. That's a big help to the US deficit. On the right-hand side, it doesn't appear to be stalling growth too aggressively in the rest of the world. I've shown their business surveys of manufacturing and industry groups around the world, above 50 expansionary, below 50 contractionary. And for the US, Japan, Euro and UK, those numbers are not spectacular, but they're all clearly above 50. So we're certainly not on recession watch yet. Secondly, I like to look at China and see how the deflationary impact of the property market and intense competition in the manufacturing sector is damaging their overall industry. Now, yes, on the left-hand panel, which shows foreign trade exports around the world, the foreign exports to the US have fallen sharply. They're down 25% year on year because of tariffs and other restrictions. But they've risen against the rest of Asia quite strongly and are stable against Europe. Now, of course, what's helping is that traditionally in the past, China was an exporter that delivered on low costs in areas like toys and games, clothing and furniture. That's all changed, and now it's manufactured goods, machinery and transport, and electronics, complex electronics. So that moving up the supply chain in China has really protected their underlying growth and exports. And the third thing I look at is whether this huge AI capex number is beginning to deliver some improved profitability and margins across global industry. Well, with the help of our friends from Empirical Research, we look at the first panel to see just how far this has come. What they've done here is ask a question. Basically, how much would a basic GCE level question cost in a company? Secondly, if you upgraded that to postgraduate complex mathematics, for example. And thirdly, if you took this up to knowledge casts, where you looked at really intensive data questions, and particularly where they need to include underlying reasoning. Now, for the left-hand side of the basic task, you can see the cost there in dollars in grey, and look at that extraordinary reduction if you use AI. And that's replicated at all levels. In fact, AI seems to cut the cost of answering questions in a corporation somewhere between 80 and 90%. This, of course, is driving huge expenditure on AI infrastructure and data centers. Now, can this continue? Well, in the right-hand panel left box, you can see the expectations in the market for increased capex going forward to fund AI in grey, almost an extra $1 trillion by 2030, and just that very slim line for the rest of the economy. Now, Jason Huang of NVIDIA, the CEO of the world's most valuable company nowadays, says these numbers are still a huge underestimate, and we've got $3.5 trillion capex to come. Now, that'll be over all sorts of areas, not just semiconductors. It'll be electricity, it'll be construction, it'll be telecoms, the list goes on. Now, there will be costs, particularly in knowledge-based industries that are vulnerable to large language models, media, banking, desktop areas. There'll be huge pressure, particularly, I'm afraid, on younger graduates and recruits. But the impact on profitability could be bigger than everybody expects. So are those three figures strong enough to support earnings going forward? Well, estimates for the year ahead seem to suggest they are. In that left-hand panel, I've shown earnings per share growth for global companies over the forward 12 months. And look at that acceleration coming out of Liberation Day. We're now expecting 14% increase in global earnings growth over the next year. The bottom line, I've put revisions. Is that rising up or down? And generally, analysts are lifting revisions, not cutting them. On the right-hand panel, dividend growth remains very robust at 11%, and meanwhile US companies continue to make vast share buybacks. So it looks as though that global profits machine is quite well supported. So what does that mean for our asset allocation? Well, first of all, we're still underweight bonds. We think the accumulation of debt is still a problem, and we don't see yet bargain basement levels, particularly in corporates where spreads are exceptionally tight. We're holding our overweight in equities on those robust earnings estimates supported by buybacks and dividend growth. In alternatives, we're neutral, holding our big position in gold. We've also got a position in absolute return funds, private equity and infrastructure. All this is funded by an underweight in cash. Now, we're not being all starry-eyed. There are risks: stagflation, inflationary boom, climate, particularly after events in the Caribbean, and of course valuations are high. But overall, we think that strong blue-chip thematic earnings engine continues to hum, if anything, even louder and more successfully than it has in the quarters past. I hope that's helpful. Thank you.